Okay, welcome back to Accounting 101 YouTube video where we're going to go over the solution to problem PF 4-29, Erickson Real Estate Appraisal. So they give us an adjusted trial balance in the textbook there, and they want us to prepare income statement, statement of retained earnings, the classified balance sheet, and then do the closing entries, and then post the entries to the accounts, open T accounts per the adjusted trial balance, and then post the closing entries to it, and then do a post-closing trial balance. So 6 requirements, I guess, there, huh? So using the adjusted trial balance, which I copied on a piece of paper so I don't have to deal with flipping around with that electronic textbook. And the first thing we have to do is the income statement. So we head it up with a heading and the name of the statement. So it's going to be Erickson Real Estate Appraisals. I like this problem because after we're all done, we're going to spend a little time with these financial statements and analyzing the company, assessing how it is and whether you'd want to buy it, and if so, how much would you pay for it? The second one is a moot question because once we look at the statements, I don't know if I'd want this company if they gave it to me. That's how bad it looks to me anyway. Where the year ended December 30, June 30th. The year ended June 30th, 2024. So there's my heading and name of the company, name of the statement, and the time frame that it pertains to. So once again, all we're going to have is we're going to show you the shell of it, and then we'll go back and fill in the details, revenues, and then the expenses. We only have one revenue, so I only left one line for it. And we go to that adjusted trial balance, and we see service revenue, and it has a credit balance of $48,100. And I'll put that under the revenue. And then we drop down right underneath it and go to the debit column. We have insurance expense, salaries expense, supplies expense, interest expense, utilities expense, and depreciation expense. So let's do them in order from highest to lowest. The highest would be salaries, and that's given at $33,500 in that adjusted trial balance. The next expense in order of magnitude would be the interest expense. Coming in a close third at $8,200 would be the depreciation expense on the building. The next one in order of descending magnitude would be the insurance expense. Didn't have the right expense there. Insurance expense, $4,400. And since I did it there, I will add it up on the salaries and the interest, just to be consistent and make it look nice. You can see I put the word expense after salaries and interest. I had written it for the depreciation expense and the insurance, so it's kind of redundant because you're under expenses, so you're repeating yourself. Next is order of magnitude would be the utilities expense. The adjusted trial balance lists them at $2,700. And finally, the supplies expense. And that's $300. Three rulers, and I took them over there. I told you, three rulers. 15-inch and two 6-inch. Just to make it neat here. I'm going to total up these expenses, call them what they are. Total expenses. And that comes out at $57,600. Those are the revenues, individual expenses, total expenses. So we have more expenses than we have in revenue, so we're going to call this net loss. And what would that be? $9,500. So now maybe you have a little insight of why earlier, just a few minutes ago, I said I wouldn't take this company if they gave it to me. $9,500 loss on $48,100 of revenues. But again, later on, we'll go through this and see what we can learn from it. Let me just give myself a little bit more room without knocking that off the desk. Now we have to do the statement of retained earnings. So once again, we get a name of the company, name of the statement, and the time period to which it pertains. And those three items are called the heading. Statement of retained earnings. For the year ended June 30th, 2024. So there's the heading for the statement of retained earnings, name of the company, name of the statement, and the time frame to which it pertains. Okay, so what do we have? Retained earnings from the adjusted trial balance would be the retained earnings as of the beginning of the year, which would be July 1, 2023. And they're listed right there between the common stock and the dividends, the 14th item down under the accounts in the adjusted trial balance, $39,500, and it's a credit balance, which is the normal balance for an equity account, which retained earnings is an equity account. Now, we've always added net income, but we have a net loss, so we're going to subtract the net loss. Okay, so net loss for the year, $9,500. Put it in brackets, draw a line, take a subtotal. It's going to give us $30,000 available for payment in dividends. Then we'll say less dividends. Go to the adjusted trial balance. We see the dividends are $27,300. And that will leave us with a balance in retained earnings at June 30th, 2024 of $2,700. Excuse me. So quite a decrease in retained earnings in that year ended June 30th, 2024, because they had a $9,500 operating loss, and then they also took out $27,300 in dividends. We'll talk about that in a little while. So now we have to do the classified balance sheet. And again, we're going to have a heading up the top, name of the company, New York City Real Estate Appraisals. Balance sheet. And it's going to just have one date on it, June 30th, 2024. So first category is going to be the assets. And again, we're doing a classified balance sheet. So we're going to say current assets. All right, so where's our trial balance? Adjusted trial balance. We are going to have cash of $4,600. We're going to have accounts receivable of $5,300. Office supplies of $1,500. Unlike the expenses where we're only showing 1 year, it's customary to put them in order from highest to lowest. With the classified balance sheet, with the current assets, we list them in order of liquidity, so that we don't go in order of magnitude. And prepaid insurance. $1,700. So those are all the current assets. Now we can total those up and say total current assets. Well, let me draw a line here to keep it nice and neat. Handy dandy calculator with my handy dandy calculator stand. 600 plus 5,300 plus 3,200. 13,100. Next category is we don't have any long-term investments, so we don't list them. And next category would be property, plant, and equipment. And we only have 2 items there. We have the building at $82,000. And notice, I believe I have 3 columns here for the balance sheet. Actually, 4. The words, the categories, and the specific accounts, and then 3 columns for the amounts. Here's a middle column, right-hand column, left-hand column, middle, and right-hand column. And this helps users focus in quickly on the information they need. The right-handmost column will be a summary, a subtotal, or something like that. And as you move from right to left, you'll get more detail. And then we subtract the accumulated depreciation from the building. So we say less accumulated depreciation on the building, $25,200. I'm out of room here. Okay. So that would be 56,800. Yeah, I could have moved that over. And then I'll say total property, plant, and equipment. Oh, I forgot land. All right. Hold on. Gotta redo it. I'm going to pause it. I didn't bring up the land. Hold on. I'm going to stop it. Okay, so here's the version 2.0 with the land in it. So after the current assets, the same as before, the property, plant, and equipment, I have land listed, $13,000. 25, 28 years ago, they told me I needed bifocals. I said no. I guess they were right, but I refused to wear them. Now we list the building at 82,000. And that would be in that left column. Okay. So again, imagine three columns, one on the left, one in the middle, one on the right. And as you're going from right to left, you're going from summary to detail to more detail. And then we take off the accumulated depreciation on the building. And this time I remember to write small enough so I could fit it all in. And that's an offset, a contra asset account, so it's going to be in brackets. And the book value, carrying value, is going to come over on the line. I'll show you what it looks like right away. Okay, so here's the building. Here's the accumulated depreciation on the building. Here's the net amount of the building. The cost of the building less its accumulated depreciation. And this number here is what we call book value or carrying value of the building. Okay, it's not its current value. The current value would be a market value. So now we add the land and the net amount of the building to get total property, plant, and equipment over here. We'll add it to the current assets to get total assets. $69,800. Yes. So total property, plant, and equipment, $69,800. That would be the land and the net amount of the building. The $13,000 on the land and the $56,800 net on the building. Add those, the current assets and the total property, plant, and equipment, we get total assets. It would be $82,900. I'm going to hold off double underlining that until I see what the total of liabilities and stockholders' equity is. Hopefully it'll balance now that I've remembered to put the land in. So liabilities. Again, a classified balance sheet. We're going to show current liabilities and long-term liabilities. So there's the major category, liabilities, and then we're going to have current liabilities and then long-term liability. So what do we got here? Current liabilities. I've got my adjusted trial balance up here. And then we got accounts payable. Okay. $18,700. And I'm going to put my current liabilities individually in that middle column, and then I'll total them, bring them over to the right-hand column. Interest payable. $8,500. Salaries payable. Oops, I didn't show it to you. Well, let me get them all down, and then I'll show you all at once. $2,400. And unearned revenue. $7,600. So I've listed all my current liabilities. I don't know if that helps. Got a lamp here. The camera on the computer adjusts for the light. So put a line under those and tally them up. We get total current liabilities of $37,200. Total current liabilities. Just because I'm neurotic, I'm going to check them. Plus 8,500, 8,400, plus 76. 32,000, 37,200. A little bit of dyslexia this evening. All I did was say total current liabilities, add them all up, put the total over there. Long-term liabilities. Payable. Notes payable. And that's the only one. So I'll bring it right over to the right-handmost column. Long-term liability is only one, so I can bring it right over. It's self-explanatory that it's the total because it's the only one. Add that to the current liabilities, and we get 77,200. And we will label that what it is, total liabilities. And now the stockholders' equity portion, section of the balance sheet. Here we're going to have our common stock. Go to adjusted trial balance, and we find that it is $3,000. Right here. Now notice, the indentations, the individual accounts, and then the subtotals, and then you come back here for the in caps or dark bold type, just to help people focus on things, get their eyes looking at it. And our retained earnings from our retained earnings statement we just completed a while back, because we want the June 30th retained earnings, and they were computed to be $2,700. And we combine that for $5,700 would be total stockholders' equity. $5,700, the combination of the liabilities and stockholders' equity. So we will say total liabilities and stockholders' equity and all we'll do is combine the total liabilities of 77,200 with the total stockholders' equity of 5,700, and we'll get 82,900. And that agrees with the total assets. So now they're in balance. I will double underscore the total assets. and I will double underscore total liabilities and stockholders' equity. Let's hold that down so it doesn't flutter in the wind. There's the common stock, retained earnings, total stockholders' equity. Combine it with the total liabilities, and you get total liabilities and stockholders' equity of $82,900, and it agrees with the total assets of $82,900. Okay, now it says to do the closing entries. One of the easiest things there is in accounting. So where's our starting point? Let me just draw a big line down here on this sheet of paper I have for journal. And all I got to do is a 4-step process. First thing I'm going to do is close all the revenue accounts to the income summary account. So I go to the trial balance. I see service revenue as the 16th item down, and it has a credit balance. So I'm going to debit service revenue for its balance of $48,100 and credit income summary for $48,100. Step 2, close all the expense accounts to the income summary accounts. Well, the expense accounts have debit balances, so I'm going to be crediting them. But what I'm going to do first, I'm going to set up my income summary account as a debit to get the total of all those expense accounts I'm going to credit. So I skip a line between my entries. I put in the income summary. Now I'm going to do all the expense accounts with credits because they have debit balances in that adjusted trial balance. So I'm going to close them out and go right down the line in order. Insurance expense. $4,400 debit balance, so I will credit insurance expense for $4,400. I'm going to save time. I'm going to write them all down. Salaries expense. Has a $33,500 debit balance, so I'm going to credit salaries expense for $33,500. Salaries expense has a debit balance of $300, so I'm going to credit it for $300. Interest expense has a debit balance of $8,500, so I'm going to credit it for $8,500. And utility expense, $2,700 debit, so I'll credit utilities expense for its balance, $2,700. And finally, the depreciation expense on the building, $8,200 debit balance, so it's going to get a credit of $8,200. Now, unlike the income statement there where we put them in descending order, highest to lowest, not advisable here. Best thing to do here is go right down that adjusted trial balance in order so you don't miss anything. If you're trying to put them in order, it may impress people, but if you get interrupted, somebody sticks their head in your office door, or you get a phone call, or something else happens, fire drill, you may come back and miss one. I have the answer here, but I'm still going to total them up. And I know, surprisingly, you know what this is going to be before you do it, because it's going to equal the income summary account after you do steps 1 and 2. The balance of the income summary account had better equal what our income statement told us happened. $57,600. All I did was total up all the expenses and put the offsetting debit to income summary. Step 3, close the balance of the income summary account to the retained earnings account. Well, we don't know what that is. I'm going to make a little T account here, call it income summary. And I'm just going to quickly put in the $48,100 credit from step 1. I'm going to put in the $57,600 debit from step 2. And I can subtract. And I see that I have a balance of $9,500 in the income summary account. $9,500 on the credit side, on the debit side. So to get rid of that balance, to get it to zero, I'd have to put a credit in income summary. So income summary, that's a credit. Okay, I skipped the line between the entries, skip what's going to get debited, and put the credit to income summary. Step 3, you always zero out the balance of the income summary account, whether it's a debit or credit. The offset goes to retained earnings. So in this case, retained earnings is getting a debit of $9,500. And if you want to look back to the statement of retained earnings, that's what we did there. We subtracted net income from retained earnings. Well, retained earnings is an equity account. How do you reduce it? If you have a net loss, you're reducing retained earnings. You debit retained earnings. It's an equity account, has a normal credit balance. So a debit will decrease it. If we had net income, you would have more credits in the income summary account. You'd have to debit income summary to close it out to zero. And the offsetting credit would be to retained earnings. Step 3 always involves the income summary account and the retained earnings account. What matters, what gets debited or credited, is the balance in the income summary account. Did you have net income, or did you have a net loss? If you have net income, income summary has a credit balance, so you have to debit it, credit retained earnings. If you had a net loss, the income summary account would have a debit balance. So you'd have to credit it and debit retained earnings, which we did in this case. Step 4, close the balance of the dividend account against the retained earnings account. So retained earnings is going to get a debit again. And the dividends account has a debit balance of $27,300. So we're going to credit the dividends for $27,300 and debit retained earnings for $27,300. And that is that. 3-step process. Close the revenue accounts. Step 1. Step 2, close the expense accounts to income summary. Close the balance of income summary to the retained earnings. Close the dividends to retained earnings. All right. That was the 4th requirement, the closing entries. Now we have to post these entries to the T accounts. I'm going to do those in red so you can see them a little bit better. Hopefully it'll show up. And the first one is, I'm going to put in income summary down here. Yeah, I better use the Sharpie. Do I have a clipboard handy? Yes. Okay, so the first entry was a debit to service revenue and a credit to income summary for $48,100. So service revenue, I'm just going to put a 1 in a circle there so we know that came from step 1. Close the revenue account. We had a credit balance of $48,100, so I debit it. Offset is a credit to income summary. Step 2, dealing with all the expense accounts. So the insurance expense, $4,400. Salaries, $33,500 credit. Supplies expense, $300 credit. Interest expense, $8,500 gets a credit. Utilities expense, $2,700 credit. Depreciation, $8,200 credit. So you can see all those items with number 2. All the expense accounts had debit balances, so I credit them. And the total of them is going to be a debit to income summary. Okay, 56 or 57,600. So now I got to figure out the balance. Is 9,500. How do I get rid of that? Step 3, credit income summary. Credit income summary with the offsetting debit going to retained earnings. And then finally, the dividends are closed out. So the dividends got closed out. They had a debit balance, so I credit it. Retained earnings gets the debit for the dividends. Now I have to get a new total on all of these accounts that I posted to from the closed. Service revenue is closed. Insurance expense. And income summary is closed. And then I just have to figure out the balance now for the retained earnings. So we had 39,500 less the 9,500 loss and the 27,300 dividends. So we have $2,700 credit balance in retained earnings. Okay. So the service revenue is closed. All the expense accounts are closed. Income summary is closed. Dividends are closed. And the retained earnings, now we had 39,500 credit balance, a debit for the net loss, and a debit for the balance of the income summary account, which was a net loss, and a debit for the dividends in step 4 of the closing process. So now, part 6. Part 6 we already did. Post them to the post-closing trial balance. They want us to do part 5, the T accounts from the adjusted and post the closings. We just did that. 6. Take the post-closing trial balance. Okay, so again, we're going to have a heading, Erickson Real Estate Appraisals. Post-closing trial balance. June 30th, 2024. How do we do it? We just go to our general ledger, write down all the accounts that have a balance other than 0, and then see if our debits and credits balance. All right, cash. $4,600 debit balance. Accounts receivable. $5,300 debit balance. Office supplies. $1,500 debit balance. Prepaid insurance. $1,700 debit balance. Land. $13,000 debit balance. Building. $82,000 debit balance. Accumulated depreciation on the building credit balance. So be careful that you put it over in the credit column. $25,200. Accounts payable. $18,700 credit balance. Interest payable. $8,500. Salaries payable. $2,400. All on the credit side. Unearned revenue, another liability credit balance. $7,600. Note payable. Notes payable. $40,000 credit balance. Common stock, $3,000 credit balance. Retained earnings. $2,700 credit balance. Dividends have been closed. Service revenues closed, 0, 0. All the expense accounts I'm looking at are 0. And income summary has been closed. So that should be it. Let's see how we did. 600 plus 5300 200 plus 13,000 82. Hmm. 25,200 plus 18,700 plus 8,500 plus 6 plus 40 plus 57. Wow. And there's the trial balance. It balances, so I know that the debits and credits are equal. The other thing about a post-closing trial balance, you should never see a revenue or an expense account, because if you did, it means you missed it during the closing process. And if you had one there, you probably would not have the total debits and credits equal to one another. Okay, earlier I said we're going to look at some of these things and see the beauty of accounting, the power of accounting. I already let one thing out of the bag with the income statement. We lost money, $9,500. Now you figure for a year, doing $48,000 for a year, you're not doing a whole lot of business. You're doing less than $1,000. I don't know. Maybe this is a part-time business. Could be. Salaries are expense. You break this down as a percentage. 33,500 divided by 41. Salaries are almost 70%, 69.6% of your revenues. That doesn't leave you much room for anything else. We have a note payable of $40,000 on the long-term liability section of the balance sheet, and we have $8,500 in interest expense and an $8,500 interest payable liability. So we had interest expense, we didn't pay it. I don't know when it's due. Could be past due, but just say $8,500 divided on $40,000. They're paying about 20% interest there. I'd look for refinancing. Something's way out of whack. The interest is way out of whack unless there's other things that were paid off during the year that I don't see a liability for. The building, let's take a look at the building. The building is approximately 1/3 depreciated. Okay, ignoring its, we don't know what its salvage value is. That is one asset that the company has. Let's look at the current assets. 13,100 in current assets, 37,000 in current, 200 in current liabilities. They almost have $3 in current liabilities for every dollar they have in current assets. They are not very liquid, are they? That would be the asset test or the current ratio that we saw at the end of the one chapter. We usually want to have at least a 1.5 to 1 ratio. This is a 0.3. Well, let me figure out what the ratio here is. 100 divided by 37,200. That's a 0.35. They have 35 cents in current assets for every dollar they have in current liabilities. Not a good position to be in. They're illiquid. They couldn't pay them all today. They couldn't even pay their accounts payable. And again, you can't use prepaid insurance and office supplies. That's the asset test ratio. We'd only look at receivables and cash. So they're even worse off. Let's see what that ratio would be. 2,600 plus 5,300 equal 9,900 divided by 37 26.6 cents in current assets for every dollar in very liquid current assets. The only thing looking good here is they have a piece of land and a building on it. Of course, the building, I'm assuming a note payable long-term liability, 40,000 is on the building. So their equity in the building is maybe 40,000. And we don't know what the current market value is. Let's look at the common stock, $3,000. this is what we call a very thin capitalized company, not a lot of ownership investment in it. Now, they did have some nice, healthy retained earnings, but they paid it out, most of it out in the dividend. Okay, $39,500 they started the year with. They lost $9,500, which will draw that down. And then out of the $30,000 available, they paid out $27,300 in dividends. Why? I'm thinking they're taking it out, and I'm probably thinking the company's going bankrupt. So between the salary, if the owner is the only employee, $33,000 there, $27,000 in dividends. There's $60,000 he pulled or she pulled out of the company, and just say goodbye, lock the door, and let everybody else fight over the garbage that's left here in bankruptcy court. Again, not a very good-looking company. Income statement is a loss. That's weak. It's shows weakness. The balance sheet shows a lot of debt, $77,000 in liabilities against $82,900 in total assets. So most of the company, what's the debt ratio there? 77,200 divided by 82,900. 93% of the company's assets are claimed. Creditors have claim on that, leaving owner is only having a less than 7% claim on the assets. Let's see, total 5,700 divided by 82.9. Yeah, 6.8%, 6.9% claimed. So, yeah, doesn't look like this company is one that I would want to own, work for, or deal with. You pay them to come do a real estate appraisal on a property of yours, and they're out of business in a month or two, and you send a check in, or they got a deposit from you, and you're not going to see it because it's tied up in bankruptcy proceedings, or they fold up the tent and go home, or fold up the building and go home, or walk away from it. Yeah, you could, somebody say, hey, I got this business I'd like to sell you. Oh yeah, I'd love to be in business. And then, well, show me the financial statements. You look at those and don't walk away, run away. Yeah, run away fast. Or again, the financials don't paint a very good picture for this company. All right. So again, we did the requirements, and we did a little bit above what was asked for in the requirements. But again, to show you how useful this information can be and why we go through the trouble of doing it. All right, I'll be talking to you in another video about Chapter 5, which is one of the easiest chapters in the book. And I apologize for the lateness of this, but I did have some trouble with some files of my computer, with some of my other courses, my tax course particularly. So it put me a couple hours behind this weekend.